Hi, welcome to the Common Fund OCIO podcast. I'm Deborah Spalding, Chief Investment Officer for Common Fund OCIO, and I'm joined by Chris Quate, Chief Market Strategist. This is the first episode of our podcast, so let's jump right in. So Chris, our macro dashboard tracks 50 variables that help us understand the macro environment and economic conditions. What signals are we seeing today? And what risks may not be priced into the market? And how does that impact our asset allocation and portfolio construction?
Yeah, well, if you look at our dashboard, and as you said, Deborah, we follow a number of factors, roughly 50, but we cull them down to these seven key macroeconomic indicators. And one thing we see is consistently strong employment, right? And that's supporting the consumer. And despite the fact that we'll probably get a higher GDP number for the third, growth is slowing. And we see this in housing, we see this in survey data for manufacturing, and we see this sort of in terms of the broad impact of lending rates on consumers. Inflation is also slowing. That's a positive trend. We went from about 9% to under 4%, but we do think it's going to be harder to get to that target of 2 without a real growth slowdown and weakness in employment. And the Fed right now is certainly restrictive, and short-term rates are high. And at Common Fund, we don't believe that we've fully digested the effects of tightening. So Fed funds rate at this level is last seen in 2007. We've had 20 months of rate increases, and we know there's a long lead time for rate increases to impact economic activity. And overall, equities are not cheap, but they also aren't very expensive, especially with this recent pullback. You asked about what's being priced in, Deborah. One thing that isn't priced into the market right now is a hard landing, and which we would view as significantly elevated unemployment and a prolonged, period of negative growth. And this makes duration and investment grade bonds fairly attractive for deflation protection. And because the market's not pricing in, let's call it runaway, a real higher inflation environment, we think it makes real assets, particularly resource equities, pretty attractive. Energy stocks, for example, are much cheaper in the market. And we have some supply constraints right now because oil companies' capital expenditures are low, right, as they're focused on dividends and buybacks for shareholders. So we're running our portfolios balanced now, and we're neutral on equities relative to fixed income, and we're staying close to our strategic asset allocation for our client portfolios.
Great. So given that background, let's turn to the asset classes, and let's start with equities, both public and private. What are you seeing? What are you thinking about?
Well, when we think about equities, one thing that is important is we do as a firm believe that macroeconomic uncertainty will persist because of things like higher rates, because of inflation, because of geopolitics, obviously. Energy now is an issue, and we are seeing a real weakening of the consumer. And so we think this uncertainty really creates good opportunities now for active management in public equities. And we think this uncertainty really makes us bullish on a factor we think of as quality, right? And so if we think about the S&P alone, more than half the stocks are down this year. Small and mid-cap stocks are at fairly cheap levels relative to history. International markets are certainly less expensive. And our managers now can really find companies with strong return on equity, high quality balance sheets, with good profitability and stable cash flows. That's a public side, the way we're really approaching it. And again, we're very focused on quality right now as we think these higher interest rates are impacting poor business models and poor balance sheets. On the private side, we are seeing a slowdown in deal activity and a higher cost of debt. But at Comfund, as you know, we believe private equity is a key component to achieving our long-term returns. We do see elevated dry powder in the space. And we also at Comfund remain committed to mid-sized firms, right, that are focused on strong management teams. And we're focused on teams with sector expertise in areas like tech-enabled services and software, healthcare technology, and business services and outsourcing, a lot of disruptive industries, which we think have a room to grow.
So two of the themes that you've talked about are interest rates and inflation. And these are, very important factors, and it's driving a tremendous amount of uncertainty. So as we think about the potential for being in a new inflation regime, you mentioned duration. How should we be thinking about fixed income?
Yeah, thanks, Deborah. I mean, as you said, inflation is an issue. It remains above central banks' target, and they remain committed to achieving the target through higher rates and a reduction in the balance sheet. And progress has been made on inflation, but we do think it's too early to declare mission accomplished. And what we're seeing now is longer term interest rates going up. And a lot of that, we believe, has to do with supply and demand dynamics, such as the Fed moving from quantitative easing to quantitative tightening. We're seeing a lot less foreign demand, areas like Japan and China as an example. And there's also less demand from banks because of the shape of the curve. But coming back to your question, as long-term investors, we believe in holding bonds for deflation protection. It's a small component of our overall portfolio. And we believe that in a recession, there will be a flight to quality and there will be a flight to duration. And so we still believe in bonds and their role in the portfolio. And because of this, we keep our duration in the investment grade part of our portfolio very close to benchmark. And we do that because we want to make sure we have that protection if, and I should say when, a recession takes hold, because there always will be a recession at some point. And then it provides liquidity to our overall portfolio.
And so what does that mean for credit?
Yeah, so within core bonds, we certainly are finding spread and credit opportunities attractive. So we're underweight treasuries quite a bit in our client portfolios, and we're finding value in other areas of investment grade, and such as mortgages, where credit spreads are really pretty wide relative to history, and that's because of the Fed not being there now, and volatility in interest rates is much higher, which causes mortgage spreads to widen. And so, the largest risk in mortgages is really prepay, right? And that's really not a risk now because most mortgages are locked in at under 4%, and the current mortgage rates are over 8%. I think a good example on the non-investment grade side would be private senior lending. That's a real focus of ours for getting non-investment grade credit exposure. And there, our managers are making loans to cash flowing companies. They're often in non-cyclical industries. And these are typically short term, several years. They have a floating interest rate, so they benefit when interest rates go up. And these loans have covenants in place, and there's intensive monitoring of them by our managers.
So then what are the implications for, say, real estate and banks? Those are two areas of the market that investors have expressed a lot of concern about recently.
Yeah, understandable. And we see a lot, particularly about certain sectors of real estate. But importantly, real estate is a broad asset class. And our PMs, our portfolio managers, are telling us that most of what they're seeing in investable real estate, the fundamentals are actually pretty good. Some areas we're even seeing rent growth, like multifamily. But the largest concerns within real estate are really in office, and particularly for cities that haven't returned to full work weeks, right? They're not at capacity. The other area of real estate that's also we see struggling a little bit besides office are specifically hotels, business hotels, I should say. And we're finding that unless business hotels are in a sunny area with attractions or at least a spa, nobody's really going. Now, if we think, so those are small components of real estate, but if we think about banks, and specifically where we're seeing pressures on regional banks, regionals are involved in a lot of smaller deals, smaller real estate deals, because commercial real estate projects when you're over 200 million, and these are major projects in big cities, they get funded in the commercial mortgage markets, and this tends to be risk that's distributed across many. It's not sitting on one single bank's balance sheet, but regional banks, where the loans are more likely to be held on their balance sheet, will experience some losses. And the issue will be rolling debt over the next several years. We think this is being reflected in the share prices of regional banks, that are now down over 30% year to date. Now, importantly, our focus on real estate at Comfund isn't on office space and hotels. We intend to invest mostly in other areas of opportunity. And one area we're focused on, for example, is digital infrastructure. And we've been making these investments for about 6 years. They're not highly correlated to things like office. And there's been growing demand. We've been doing this because there's been growing demand in e-commerce. There's a lot of growing demand in data storage and consumption, on-premise, IT infrastructure and cloud, and even things like supply chain logistics, such as how food is stored and distributed. And so we've made investments in areas like data centers, fiber companies, tower assets, and even spectrum.
Wow. So when you put all of those asset class dynamics together and you look at it from an overall perspective, how do higher rates and inflation then impact overall returns and the ability to achieve CPI plus 5%?
Yeah, we build portfolios that will meet long-term objectives for endowments and foundations, and these are achievable goals, right? But they require a growth focus. We need a lot of equity focus, right? And we need to take liquidity risk. We need a healthy meaning, our clients need a healthy allocation to private markets. And also we need appropriate degrees of diversification for downside protection so our clients can get through the downturns in the market. So we're very much guided by the strategic asset allocations we build for our clients. And openly, one of our concerns going forward is that we could be in a higher inflation regime, right? And we're not talking about today, but we're talking about, the next decade, as we're dealing with things like an aging population. We're obviously dealing with geopolitical risks, deglobalization, and we're also seeing, I'd call it potential changes in the power of labor. And so this could make it a little more challenging for clients to achieve their return goals over the next decade, because we think of everything as a spread over inflation. And so what we've been doing is we've been working hard with our clients, spend a lot of time with our clients to understand, help them understand their need to take on liquidity risk to meet their return objectives. We've been working with them to understand their ability to invest in privates, right? Ensuring adequate remaining liquidity to meet their spending needs, and stress testing portfolios and whatnot. And we're also helping our clients understand and gauge their comfort with private investments through education. And we're doing this because our clients need to capture this liquidity premium from privates. And over the last 5 years, the average increase in the illiquid allocations for our clients was roughly 15%. And as you know, Deborah, we're fortunate to have both an OCIO business and a private equity business at the firm. And our clients get the benefit of that access that Comfund Private Equity, has built over 35 years investing with leading managers.
It's interesting, we talk broadly and we hear broadly about these themes around inflation and interest rates, but as you describe how that plays out across markets and across asset classes and across portfolios, is really quite different. So wanted to thank you, Chris, for all of that food for thought. Very interesting, good to digest. And that is it from us. Stay tuned for episode 2 of the Common Fund OCIO podcast.
Thanks, Deborah.